Hello everyone, welcome back into today's video. My name is Danny once again with Scorpro Financial, and today you're gonna see a great conversation that I had with a mortgage loan expert. His name is gonna be Marcel. We're gonna be talking about how we're part of a BNI networking group and all these really cool things. So stay tuned. Please let me know if you have any questions, any concerns. Feel free to leave them down in the comments. And then yeah, I'll see you on the inside.
It's been what, a year in the making?
Yeah.
Has it really?
No. When did you start in the BNI chapter?
Dang, I don't know.
It hasn't been a year yet because you haven't hit renewal.
No. Wait, how does that work? Do you have to renew every single year? Like, how does that work? I don't think I've ever asked.
So you'll be notified by BNI in that you have to, your application's coming up, and then you submit a renewal application. It'll come to you in the system, and then it'll ask you for the payment. Okay. And so I think the payment is like $1,200.
Did it go up?
It seems like it goes up every year. I know. I think to join is $1,299.
Yeah.
I think to renew is $1,200. I hope.
Didn't you use renew?
Yeah, but it's due March 1st. So
you don't know.
I like to see my money in my account as long as possible. So it's due on March 1st. I intend to pay on March 1st, not February 28th. March 1st. I like to see the numbers. I'm a banker. I like to see holding that money as long as possible before I have to spend it. So I think it's $1,200. The reason I think it's $1,200 is because Dell renewed, and I saw a receipt for $1,200. Mm-hmm. So I'm like, oh, cool. I'm saving $100 more than I thought, rather than the $1,299.
Yeah.
So yeah, you do have to renew every year. And you know what's bad is, I've probably mentioned this 10 times. I was president of a chapter in Michigan before, and I don't know if it's a regional thing or something that BNI has changed internationally, but when you're the president, vice president, or secretary treasurer, the way it was before is you didn't have to pay for your membership.
Oh, no way.
And I don't know if that's something that they just do regionally here, or the BNI has changed worldwide, but you have to pay for it. And we put in a lot of extra time.
Yeah.
A lot of extra time. And the thing is,
you guys will get discounts.
Yeah, we should get discounts, especially because if I did a bad job, terrible job, either they would have to boot me out or the chapter would fall apart. One of two things would happen, but it would affect attendance. So basically, I'm drinking the Kool-Aid. I've made a lot of money of BNI over the years. And so what I get up there and say in the meetings, I believe it's coming from the heart, right? Like, hey, you can make this work. But if we get 10 extra people to join, and that's, $10,200 to BNI, I don't get 1% of that, but I'm up there working to grow the chapter, and it has it's beneficial to me because more business opportunities and so forth. But you would think that would be included.
Yeah, I thought so too. You guys should get a benefit, especially the vice president role. Vice president's crazy.
Yeah,
vice president role is crazy. I was gonna ask you something, and I'm forgetting now that we're on air. But you did mention, right? You're a banker. You've been in BNI for 11 years. Oh man, I remember. Okay. It's crazy because you can actually see how, obviously going through numbers and data that I have for the last year, you can actually see the spike whenever I joined BNI.
Yeah. Good.
You can actually see it. It's pretty cool.
Good.
It's pretty cool. You could, and I did the annual checkup. It was in December, and then you could take, I think it was June, July, probably when I joined. And obviously it kept kind of the same, and then all of a sudden it just went like a little spike on changes and things maybe 2-3 months after. So I was like, oh, what did we do different? It was the BNI experience. So
right, yeah. One of a business coach, Coach Michael Burt. Several people on my team within my company have been part of his program, and he has a great program, Monster Producers and so forth, and. One of his big lines, one of his big catch lines in coaching is that you don't need to make more money, you need more people. And when you meet more people, the money comes with it. And that's one of the good things that BNI provides to you is the more people. And it's structured, so you've got some obligations to make, and it keeps you more accountable. But that's good to hear.
Yeah,
good to hear.
It's interesting because honestly, I think I've told you multiple times, I don't come in just for the, I want to grow, I want to do all these things, but more for the safety aspect for how my industry is. and I think I told you this about, that I gain more by having that trust factor from people and professionals that really trust my business as a whole, more than, how many leads I get, how many referrals I get, more than anything.
Right.
And it's been awesome. Like,
what do you mean by the safety factor? I'm not sure. I want to make sure I understand that.
So
correctly.
I am a credit repair company, right? I own a company called Corporate Financial, as you know. And what we do is we fix people credit. Unfortunately, the entry requirements for you to provide credit services are very low, which leads to a lot of people being able to have access to providing the services that might not be qualified enough, or they have the proper professionalism or knowledge to be able to provide services like that, leading to a lot of scams, a lot of people getting ripped off, a lot of people not getting what they're paying for. And that is something that just the industry carries. I know for you, for example, so all industries have that little bad thing that they have to deal with. But for us, it's trust. The trust factor. So joining a chapter like BNI has led me to people getting to know who I am, people getting to know how I do practice of services, people knowing how I actually deliver the services that I do. And it kind of adds that stamp of security that the business is real, that what I'm offering, it's what really works. What I'm offering, it's what I'm trying to help, instead of, hey, you're not gonna hear from me, give me $2,000, $3,000 and I'm never gonna see you again, deuces.
Yeah, you do see that in the credit repair industry. That is a common concern, and myself being a mortgage banker, we see that more often because it's a natural sphere to do business, to need a good go-to credit repair person. So having you come into our sphere, into the BNI Downtown Miami chapter, was a blessing because it was a natural fit. And it's nice that every week I get to learn more about your business, but then also I know that I'm going to see you. And you've built up trust and credibility regardless of whether you and Scorpio Financial were in the chapter. But it's nice, like in the beginning phases, to say, okay, I'm going to see this guy next week, and I know, and I can ask him about it. So he's not going anywhere. The other thing is that you invested in your business, and so to be part of our networking chapter, you've got to invest in your business. And say, hey, I'm going to pay this annual membership fee, and so you know that people that are paying that annual membership fee, they're willing to invest in themselves. They're willing to bet on themselves.
Correct.
And so that's one of the things that I like about BNI.
I mean, you have to show up.
Yeah.
You actually have to show up. Like the keeping you accountable thing, it's like, okay, whatever, right? You have to do what you have to do. A little cultish for my liking, but it is what it is. But the fact that now, let's say you got a referral, or you just moved somebody to somebody else, and now you have to be on the lookout. Now you're on your toes. It's
right.
like, hey, don't drop the ball. Right? It adds that little aspect of, oh man, I really need to do what I'm saying that I have to do. And for like early, we have members in our chapter that are starting their journey, right? Whether it is with their businesses or like just in BNI alone. But I feel like everybody at some point deals with like the imposter syndrome status. At some point, it's like,
right.
Can I really do what I'm saying that I'm doing? Even though I have some experience, even though I've done it in the past, I know at some point somebody feels that when you're entrepreneurial road, and it helps with it. Like, hey, somebody gave me a referral. I need to face this person the next week. I need to do something about this. And even if I'm not, I need to be honest enough to say, hey, I'm sorry, I will not be the best fit to be able to help, but the best one, I'll do better, right? Like it helps with all those things as well.
Definitely. So you talked about imposter syndrome. Let me ask you a question as I'm thinking about credit and clients. So I see a lot of credit reports because I do mortgages, but generally if somebody comes to me, they have the hope or the expectation that they can get qualified for a mortgage. And some people, they can, and they're far off, but most people, they have that expectation. So that's not the whole population or the general population, because some people are far away from buying the home. So my question is, because you deal with credit repair and you deal with more clients, people that want to buy cars or just get approved for credit cards or stop getting penalized because they have bad credit with insurance and so forth. I don't know if you know any statistics or if you had to guesstimate, what percentage of the population, the U.S. population, do you think either has bad credit or experienced bad credit or will experience bad credit sometime in their life? If you had to put a number on it, do you know?
See, I've been doing this for a lot of years. So it changes every now and then, especially, for example, you as a banker, you have the requirements for an FHA loan, for example. They usually keep it at 580 is what it is now. Sometimes it will go down to 540. Sometimes it will go down maybe to a 600. So it varies, the requirements. But on average, around like a 580, right? So if we're basing it that, if we just keep that, let's say the population, everybody wants the American dream, we want to get that first home, right? The minimum requirement that you need is a 580. So I'm going to take that into consideration for the stat that I'm going to tell you. Somebody will hit a 580 at least once in their lifetime.
Most people will.
At least. So I'm willing to bet that we're doing 80 to 85% of people in the United States will hit a point where 580 might be too high for them to be able to get a home.
Yeah. And so I thought about that. The question came to mind because we talk about imposter syndrome because, I was raised like, hey, take care of your credit. It's important and so forth. So I would be embarrassed to say, hey, so that might be one thing that people need to get over if they want your service, especially if they know you, if they're introduced to you from BNI, they might say, hey, I know this guy was introduced as an insurance professional and I would like to get insurance business from Daniel, but I don't want to tell him that I've had these events that happen and my credit is bad. Could be a divorce, could be illness, loss of job.
Divorce is a huge one.
So you could be a very responsible consumer and have that mentality you're going to pay your bills, but what happens if you get sick with cancer and all of a sudden you can't work and you don't have the proper insurance? Things can happen in life. Divorce.
Things happen.
So yeah, that's kind of what I was curious about, and I've encountered that where I know every once in a while somebody doesn't maybe they want to do a mortgage, but they come to me, they may be embarrassed about their credit or they don't want to share the debts that they have. They're like, hey, I make good income. I don't want Marcel to know that I'm irresponsible with the credit cards, that sort of thing. So there's that, can relate back to that imposter syndrome. So that was something that I was curious about.
You'd be surprised. Like I've been in networking events. I've been meeting people in events and I'll be sitting down on a table, and this happened, actually, this is very recent. This happened to me last year. I was at the small business something here in Miami. It was like a big networking event here. And it was kind of like a speed networking section, and people were just sitting on some tables and stuff. And I sat down at one of the tables, and I asked, hey, what do you do? I think the guy was like, he moved metals, or he moved like precious stones like rubies and stuff. So it was like a big business, like minerals and stuff. And the other one moved like oil and things like that. So they were like big businesses. And he said, oh, so what do you do? It's like, oh no, I'm a credit repair company. And then they looked at me and they looked up and down and they're like, why are you sitting here with us? I'm like, oh, well, sorry. Yeah, I'll go into a different table. I'll say maybe like an hour later when I was about to leave the event, one of those guys pulled me to the side. And he said, hey, your name was Danny, right? I was like, yeah, my name is Danny. Hey, sorry about that. I was trying to work into a deal, but I really need to talk to you. I have some things about my credit that I need to fix. But, I didn't want to say that I have bad credit when I'm trying to do business and things like that, especially when a company's moving so much money with precious stones and this and that. And you see that a lot. People, they feel embarrassed about it. And that's something that once people understand that it will happen to everyone, life happens. So you can get in an accident, right? You can get into a divorce. Sure. You can get into sickness, disease. A lot of things can happen that you might not be ready for. And it will come to get you. And it's not because you're a bad consumer, just like you said. It's not that you don't know how to deal with your finances. It's just, it happens.
Right.
So, yeah, it does.
Yeah. Well, one of the things I like about you and your company is that because it can be embarrassing, if somebody has bad credit, is that I know that you and your company are going to be professional.
Of course.
That it's nobody else's business. And so if you're dealing with one of my referrals and it's somebody that we know in common, maybe it's a friend of both of ours, that that is kept in confidence. And
Of course.
we like to say in the Latino community, we're not going to be chismoso about it. And so, and that's important. That's important. Like my clients want to know that they're working with me and that I'm keeping their information private. Whether they have $4 million saved up in the bank and they don't want people to know about that, or they are barely have enough funds to come into the closing, and after they close, you're going to have a couple $100. The information is confidential, and that's just part of being professional. And I know that we get that with Score Pro Financial.
Yeah, that's pretty cool.
Yeah.
So, going back into you being a banker, right? What are you seeing right now? Like, as far as I know, you probably get this question probably once a day. How are interests looking like?
Sure. Well, we've been spoiled. The last couple of years, everybody knows that interest rates in the United States on mortgages have gone up. Everybody pretty much kind of knows that. Even if you're not in the market to buy a house, you see it all over the news. Historically, and this is going to sound like a sales line, the interest rates are not, they're still low. We're looking anywhere in the mid sixes.
That's still considered low?
To 7%, yeah. So,
I wonder if it's because, probably the being spoiled that I never thought about buying a home here, but then every time that I was thinking about buying a home in the last couple of years, it's like, oh, interest is 2, interest is 1, interest is 3, and things like that. So now that you're saying that, oh, it's 6% is still very low, for me, it's like, how does that, like, where does that come from? That's a big jump.
So I also an investor in real estate, and looking at foreclosures and stuff. And you look at some of these people, because they fall in hard times, and let's say the mortgage is 20 years old, I see interest rates like 12, 13%.
Oh, man.
And that was nothing to them at that point. They were like, it was just normal, right? But in 2001, 2020, during times of the pandemic, 3% was a very common interest rate on a 30-year fixed. And then you had some people that even got into the high twos, like 2.875 and so forth. And they stayed like that for a couple years, and so people can't come to expect that, and they think that it's normal when really it's not. Some people say we will never see that interest rate again, and to me, never is a very long term, right? Is it likely? No. Obviously, I don't think that it's likely, but I think at some point in history it'll happen again. If you want to buy a house, my advice to you wouldn't be to sit and wait for it to get to 3% again, because it might be 30, 40 years. You might be retiring and you'd be in an old folks home before it happens again, but you never know. It could come around. The thing about buying a home is that it's an investment, and for most Americans, it's their largest investment in their life. It's where they have most of their savings. It's a vehicle to build up savings, and it can become a powerful tool. Not only do we help people get into a home, and maybe they need your credit help, but then they can leverage that home to do other things, because in a normal healthy economy, that home's going to appreciate maybe 10% a year, somewhere around there.
That's usually the average per year.
Yeah, I don't want to get nailed down to a number, but it's right around 7 to 12, about 10%.
Give me a range. Give me a range.
About 7 to 12% a year. Now, during that course of 5 years, if we hit a recession or there's a slump in the housing market, it can go down, but that's part of that average. We're like 7 to 12%.
Okay.
And so it's hard to save that kind of money. Meaning, if you put a down payment on a house, now you've got that house, let's say a starter home in Miami, and Miami's a very expensive market, but let's say a starter home in North Miami, and it's right now about $550,000, $600,000, and really that's not even that nice of a house. If that's appreciating, 7% per year, 10% per year, and you're not locking down the property while you can, then you've got the inflation of the dollar. In 3 years, that house might be in the high sixes. Now, as of today's date, there's a lot of things going on. That there's some downward pressure on the market. That kind of stuff changes because of the high cost of insurance right now, the high property taxes. And it looks like we're going to go into an adjustment period where the prices aren't rising as fast. We'll see. But there's factors that are just complete wild cards. You got the governor talking about.
That was literally my exact same question.
Yes.
It was going to come next. I know Miami is like its own ecosystem at this point, right? When it comes to loans and mortgages and stuff like that. And then added to that, you have the governor saying that it was one trying to remove
property taxes.
What's up with that?
If I don't know if he'll get it done, but my take is I've seen him, don't want to get into politics.
He's done a lot of things.
Yeah, he's gotten done a lot of stuff done that he said he was going to do. Whether you like it or not, well, that's up to you. Whether it aligns with your political beliefs or wishes.
Respect that.
Right. But him uttering that, I think that he'll try to get it done. And if he gets it done, then you're going to look at property values just go up more because it's going to add more affordability to the market. And then you get the law of supply and demand. Now that more people can afford it, there's going to be more people buying, which is going to put upward pressure on the prices. So my advice is you don't want to get tunnel vision or analysis paralysis looking at the interest rates, which we feel are high right now because we've been spoiled, and not make a move. And so my advice is if your home ownership is something that you're interested in, and we can give you qualification numbers, and if they work for you, lock that property down, because we have inflation, dollars worth less, then you're going to have the upward pressure on the property. You want to buy it now at $550 because in 4 years, if you're just saving, or waiting for the interest rates to hit this magical 3% again, now you're buying that property at $650, $675, something like that. Whereas you can always renegotiate the rate later. Lock that property down. What you want is I think this is a powerful thing. You want your name on the title of the property.
Walk me down through that process. Like I've heard you a lot talking about, hey, I know you should buy now, even though there's a lot less pressure you can probably look into the house that you really want right now because there are not that many buyers. Even though things are a little bit more expensive than how it used to be in the past couple of years, you should probably do it. You can then refinance later. Can you explain to me a little bit how that is? Like how is there like a specific time frame where you can refinance, or like how does that work?
No, you can. Most of the loans in the United States today don't have a prepayment penalty. If you do some sort of what we call non-QM, non-qualifying mortgage, where you do like a bank statement loan and stuff like that, those loans are higher risk, and so those will have a prepayment penalty if you pay it off with the year. But most loans that people qualify for don't have a prepayment penalty, which means that, if I buy a house today and then something crazy happens and next month I bought it and I'm at a rate of 6%. And next month they're at 4%, I can refinance that and get the lower interest rate, lowering my payment.
So do you have to go through the same banker to like?
No, you can go to anyone you want. And even if I mentioned the prepayment penalty, I don't want to get too much into the details, but let's say you're doing a non-qualifying mortgage and it's a bank statement loan, and they say, hey, there's a 1% prepayment penalty. And next month, all of a sudden, 2%, I've never seen 2% in 1 month, but they go down 2%, great opportunity. Man, I'm stuck at 6%. I want that 4%. With the prepayment penalty, the 1% is just 1% of the loan amount. So you can still pay that and get the lower interest rate. And if the interest rate drop was that big of a drop, you're going to want to do it. As a banker, I'm going to break out the calculator. I'm going to say, hey, this is what it's going to cost you to get this refinance done. This is what it's going to save you per month. Let's say, for example, you go from 6% to 4%, and it saves you $600 a month. And that refinance costs you $5,000. Well, hey, you're saving, what did I say, $600 a month? $600 a month divided into the $5,000 for the refinance or whatever it costs you. This is how many months it's going to take you to recoup those costs.
Okay.
And then you say, well, wow, $5,000. Do I have that cash? You don't necessarily have to bring in the cash to the closing. A lot of times we can put that in the back of the mortgage. Yes, it'll add to your principal, but all of a sudden your payment goes down several $100s a month, and you say, hey, I don't plan on selling this house. It cost me this amount of money, but in 48 months, for example, I'm going to recoup the cost of my refinance. My payment went down immediately, and every month after that 48 months, not only did I recoup the cost of refinancing, but now I'm saving money. I locked a lower interest rate in place. So that's where you want to be, is where you lock the property up. That's what I try to tell my clients. If you can, don't put yourself in a financial situation where you can't eat or you can't enjoy life. But if you want to buy a property, and even with the higher interest rates, it might not be your favorite interest rate, a rate that you like to brag about at the cooler, but if you can afford it, then you start building equity right away. You build equity in that property, and it gives you cash reserves. And then as the interest rates go down, you can float the rate down. But you can refinance at any time to answer that question.
Awesome. And then you did mention prepayment penalty, right?
Right.
Obviously, you and me understand that, but there might be people that don't know what that really means. So do you mind explaining that?
Sure. Prepayment penalty is basically, so a lender, when they put a bank, when they put a loan together, they want to make money off of the interest that you're paying on that loan. That's how they get investors. That's where they get their money, retirement funds, hedge funds that invest in these banks that do mortgages. Well, in order for them to offer those, they've got to have a portfolio or a group of mortgages that performs. It means it makes money. So if you pay off the loan too quick, then they don't make money off of that, and that's why they charge a prepayment penalty. They say, hey, Danny, we want your loan, but if you refinance in 1 month, we lost money, even though you made one payment, even though you had these closing costs to the title, to the county, all that kind of stuff. We did all this work. We have a staff that got this mortgage, this loan done for you, and after 1 month or 2 months, you refinance. If you refinance within the first year, for example, we're going to charge you 1% of the loan amount because we have a cost of doing business.
Got it.
So so that's why they have a prepayment penalty. They used to be more common. Prepayment penalties, maybe, I don't know, if I had to guess, let's say 20 years ago.
Okay.
They're less common now, unless we're dealing like with a non-qualifying mortgage or something like that. The higher the risk that you are as a buyer, the higher the interest rate you're going to pay. That's why credit is one of the factors. But let's say you have a lower document loan because maybe you don't claim all your income, or you have a business that qualifies you for a lot of deductions, but the business still has a good cash flow. Well, there are lenders that will do that loan for you, but because it's a higher risk to them that you could default on the mortgage, they charge you a higher interest rate. So they'll say, hey, Danny, we're doing this bank statement loan for it. It's a little bit more risky. Bank statement loans have a 15% fallout, where a full doc loan has a 2% fallout. So we can't give you that 6%. We're going to give you 8.5% because that makes it worthwhile to take this risk with you.
Okay.
Because the last thing a bank wants to do is take the property back from you.
Really?
Yes.
How come?
Because it's a very costly, time-consuming endeavor.
Okay.
So there's a lot of risk to them. I've heard people say, I'm going to give my house back to the bank, or hey, I stopped paying on the mortgage, I couldn't afford it, had these circumstances, divorce, whatever, I gave it back to the bank. And they're like, well, you know, there was 15% equity in the property, so the bank's doing well. But in reality, that money gets eaten up so quickly because now the bank has to pay the taxes on the property. They have to pay the insurance on the property. They might have to secure the property if it's in a bad neighborhood, meaning, well, they'll have to secure it no matter where it's at. They'll have to change the locks. They have to hire a realtor. They're going to pay 6% commission to a realtor. So that down payment that you made in that property, the equity you built, gets eaten up really fast. And the banks are not in the business of managing properties. So they have to hire someone else to do that. So it becomes a very costly adventure for them. Imagine Chase trying to rent out your house or whatever. You're like, that's weird. Like, they don't have the people for that. What is the teller going to come? You know, it's the same thing. Like, so much, and then the legal process through the court. So it's the last thing they want to do. That's why you have the systems of checks and balances to check your credit, to check your job, to check your income, because they want to lend you the money and make some money off the interest, but they don't want to manage property.
Got it. Oh man, that's awesome. What's the highest equity gain that you've seen on a property since you've been a banker?
Ooh, you know what? I've never
been surprised by the one that you've been like, oh man, this is crazy.
You know, I continue to get surprised all the time. Like, I firmly believe investing in real estate. I want to buy more investment properties myself. But I mean, I've seen people buy a property for, let's say, $400,000, and in a matter of 5 years, it's worth $600,000, and they're just making the minimum payments. Well, the average consumer, the average American, trying to save $200,000, if you're working a W-2 job and you've got a set income, like, you'll never be able to save $2,000. I know we live in a different economy. There's people that make $200,000 a month and internet sales and stuff like that. But if you're working a W-2 job, to try to get ahead and to save that kind of money is tough. But a property can be a vehicle where you can do it very fast. Yeah.
See, I've never done it. I've always been very curious about it, but I've never really dwelled myself. Again, I don't even own a property. So for me, all that side is oh man. Yeah. It's exciting. So many people do it, so it has to be good, right? Or do you kind of turn it down because too many people are doing it?
No. I mean, there's so much opportunity out there in real estate, and I mean, if you just drive around, you could. I'm sure Miami's a hot market, right?
Mm-hmm.
But I'm sure you could drive within a square mile and find an abandoned building or abandoned house.
Hit downtown, you'll be right there.
Yeah, so there's opportunities out there. You just have to go out there and find them. But there's a ton of opportunities. But I have a question for you, because I want to share this with some of my borrowers. And I kind of know the answer, but I know that you're going to give a better or more articulate answer. If somebody has a collection on their credit, a lot of times a borrower, if they don't talk to me first, they'll say, well, I'm going to pay off these collections and then I'm going to come to you. But it can also oftentimes lower their score. So if you could explain to my followers, my listeners, why the paying off, it seems counterintuitive, why paying off a collection could hurt your score.
Yeah, well, there are multiple factors into it, right? Like, for example, time is literally it's ingrained in the formula for a credit score. The longer you've been dealing with something, either the better or the worse it could be. For example, the longer, if you've been dealing with credit for 10 years, you have mortgages, you have cars, you have credit cards, you're a pretty safe person to lend money as a banker, right?
You mean because they have a lot of history?
Because they have a lot of history. That means they've been dealing with, hey, he's been having a mortgage for 5 years. He's never gone late, right? He owes a lot of money in it, but it already shows me that he can deal a long-term installment account inside of their credit reports in comparison to somebody that maybe just has 3-4 credit cards. And then it comes to you trying to get a mortgage. It's like, hey, you've never dealt with this big amount of debt. How do I know that you're really going to make this happen, right? I know you can handle $5,000 on a credit card, for example. I know you can handle $1,000, but I don't know, $500,000. I mean, what's the average home right now in Miami? 600, 650?
You know what? I haven't checked that number. So I want to give a great number. I want to just nail down the number. I haven't checked the number in several months, but I probably would say around 623.
See, that's so specific.
I don't want to give a specific number, but
here's a specific 623 with 50 cents.
Yes.
For example, so somebody that has been dealing with a credit card for $5,000 for the last year, and then all of a sudden it needs $623,000 and 50 cents loan. It's kind of like, oof, this is a new realm for you, right? So that's how that plays. As when it comes to collections, the longer they've been inside of your credit report, the least they affect you, right? So first, when you see I don't know if you've gotten this experience, but usually you hear oh my God, I got a collection and then my credit score tanked right away. It's because you usually lose between 70 to 100 points once a new collection comes in. Right, it's really just everything is good, and then all of a sudden, this person stopped making payments. Something happened, your credit score gets hit really hard. Let's say you keep that collection, everything, an account inside of your credit reports will stay there between up to 7 years, to be honest. Sometimes they will fall off earlier, but on average, the 7-year mark, unless you're a bankruptcy, for example, it can be there up to 10 years sometimes, right? But it will be there for 7 years. The longer that collection goes in your credit report, the less impact it's going to have in your scores. All right, it's not like, let's say you get that collection and then it keeps dropping 70 points every single year that it's there. Most models, when it comes to your credit score, they take into consideration the last 2 years of payment history, the last 2 years of activity. So that's why after that 2-year mark, things start kind of like settling a little bit more. It's like you're already part of it. It's ingrained. It's like the no like birthmark that you're getting there is part of you. Right. So it doesn't affect you as much. So now
by law, it has to be removed after 7 years, right?
That's what they say. But now the credit bureaus are being sued because they don't do proper practices.
Okay. So that's where you come in.
Exactly. And that's where we will come in and trying to help people. But, taking that into consideration, right? Let's say you paid a collection, whether it is new, whether it is old. If it's older than that brand set of time that we've been talking about, the 7-year mark, it's only gonna, that 7-year period is called the statute of limitations. Okay, that's the time frame in which a collection agency, an account is meant to either call you, reach out to you for that debt, and that's the period of time in which a negative account, derogatory, will be inside of your credit reports. Once you make a payment, for that old collection just because somebody told you, hey, you need to pay it to be able to have it fixed. One, if you pay a collection, it's gonna restate that statute of limitations, meaning, yeah, it was 6-year mark. They haven't talked to you. They haven't called you. You know, collection agencies, they're ruthless. They will call you 3-4 times a day. They will send you emails. They will send you mail letters. After a period of time, it kind of starts dying down.
You're at a restaurant, you're ordering some food. Like, by the way, it's me. You owe me money.
right. But if you make a payment, you pretty much restart that clock.
Right. Yeah. And it appears on your credit report as the date of last activity. And if that date of last activity, let's say it was about to fall off, you're saying like you're at 6.5 years, it's going to fall off in 6 months. But now that you made a payment, now it starts
all over
that
again.
clock again. Well, one error that I see borrowers make because they don't talk to a professional like you, they try to fix their credit on their own.
Which is okay still. You can fix your credit on your own.
Right.
There are ways for you to do it.
But I know it's very time consuming and they can make mistakes. And I feel that using a service like yours, Score Pro Financial, can save them money. Why? Because if they have a collection that's 5 years old and they pay it off, the older that, like you said, the older that collection gets, the less it affects their credit. Mm-hmm. So the more time that passes, then the less it's affecting their credit. And then they renew it by paying it off. All of a sudden, that's a negative event that's brought fresh in the memory, so to speak.
Correct. And that's when their scores goes down.
Down, yeah. So what we like our clients to do is to negotiate a deletion. Hey, Mr. Creditor, I owe you this money. I can borrow the money or
it's called a paper deletion agreement, by the way.
Pay for deletion. Yeah, that's what we want them to say. Because a deletion is like it never happened at all. It gets wiped completely from your credit report.
Right. And that gives you a big boost on your scores.
Right. But this is something that you see all the time, right?
Yeah. Yeah.
So the advantage is if I send a client to you, you might have experience working with that collection company before, that creditor before, and you say, hey, I happen to know this ABC company. I just negotiated a pay for deletion, and I talked to Mark in Wisconsin. That was the operator I talked to. We're going to call that same guy up for you because I know he'll get it done. I talked to 3 other people at his company before I talked to that guy, and he's the one we want to talk to. I've got him saved in my database. So if you get that deletion for my client, we're going to be a lot more likely to be successful on their mortgage. It's going to bring up their credit score, and you could be saving them thousands of dollars. You might say, for example, I've seen where you could tell me, hey, they owe $2,000. We can negotiate a pay for deletion for $1,000 with that company. And now, if that client hadn't come to you, they may have paid the full $1,000 or $2,000, whatever it is. But you know that ABC company will negotiate for less.
Correct. I mean, on average, whenever it comes to a settlement agreement, you don't want to pay over 30% most of the time of the maximum balance. Whenever an account goes into a charge-off state, right? Let's say Chase, American Express, they marked it as a charge-off account for you. They close your account and mark it as charge-off. What they did is that's already written as a loss in their books. So then all of a sudden you get a collection agency coming in and say, hey, Amex, do you have any their collections there? It's like they already marked it as a loss. It's like, how much is that debt, for example? Oh, it's $10,000. They will say, I'll give you $100 for it. They literally buy cents on the dollar for these type of debts, right? And American Express already marked it as a write-off. It's already, I already lost this money. I might as well just get $100 out of it.
So you're saying, let's say somebody has a bad event, they owe American Express $10,000. And then you said that American Express, after a certain amount of time, they'll write it off as a loss. And then they're selling the debt to someone else.
Correct.
And then they're selling the debt for what?
$100, cents per dollar at this point.
So the person owed $10,000 to American Express. American Express counted as a charge-off. You had damaged your credit, and then they sell it to a debt collection company who makes money off of trying to collect the original $10,000. But they buy that debt cents for $1,000 or $500. So that's why you're saying they'll negotiate less because they're
already making profits no matter what. So yeah, you usually say, hey, settle for 30% of it. That's what they're able to give you, a settlement agreement or a settlement after you start getting the mails or the emails of, hey, your debt was $10,000. We'll bring it down to 7,000 out of the 10,000. They're making a crazy amount of money already out of it.
I want to get a direct collection company now.
Went that route. So they make they're extremely profitable. Obviously, it's not a fun job. You have to call. You're literally trying to reach out to somebody that already knows that you're most likely not going to make any money. But whenever you do, it's a 100x type of profit. So yes, trying to settle 30%. And now at that point where if you want to agree into like a deletion agreement, I'm willing to say that usually I tell my students, hey, you can go a little bit higher, but if it guarantees you that they're going to remove it, right? So sometimes what they will do is that they will tell them, oh yeah, well, we'll agree to a 30% or a 40%, but they never send any confirmation of that. So the person pays for the 40%, and then now they don't remove the account from the credit reports, and they already made so much money out of it by upping the type of settlement that they were getting on average. And now they don't have a way to combat that. So now you have a paid collection that got renewed inside of your credit reports, and now it's not coming off. So you paid more, and you kind of screwed yourself after that, right? So always make sure that you get any type of written confirmation, email confirmation whenever you're doing any type of settlement agreements, because you could use that to dispute in the future if needed that they don't do something.
And the average person doesn't know this kind of stuff. That's why it pays, your service pays for itself.
Correct.
Because you have all this years of built up skills and knowledge that you've learned and experienced, and that's just invaluable. So
yeah, no, I mean, I do it to help, right? I think you know a little bit of my story. I went bad south with my credit multiple years back, and that's where all of this came from, right? So
the life of a professional athlete, huh?
Those are great stories. Those are great stories. So I'm willing to say, like, just to finish up that debt settlement stuff, you can go up to 50%. That's probably what I usually tell them. Hey, go up to 50%, have them guarantee you, send you the letters, and if it comes off, it comes off. And hey, I mean, you still paid 50% on whatever original debt you was. It wasn't 10,000, but you paid 5K, and now it's off your credit reports. Now you gain an extra 30, 40, 50 points from removing that account. Let's say you're bringing down the credit cards that you have for your credit utilization. Now you're playing the game, and you're trying to get back on track.
Gotcha. So I want to throw a credit score at you, and something that you mentioned in the earlier conversation, and then I want to come back to just credit in general. So because you work with a lot more than one mortgage lender, you don't just work with me. You cast a wide net. So generally on FHA, the lowest credit score a lot of lenders have is 580. But at first, I want to say to you probably that we recently got somebody done at 540.
Oh man.
Now, they had to put like 25% down. It was an FHA loan. Generally, people like FHA because you only have to put 3.5% down as a minimum payment. And then they take a little bit of more damaged credit than a conventional loan.
I saw that you can talk to them directly, right? Like you can actually kind of like wave your way into approving something that is not a 580.
Right.
I just recently heard that.
Yeah. So what happens is that a lot of lenders, they have what they call overlays. So you have the government rules. Here's the bare bones FHA government rules. And they may say, I think it's 520. Don't cast that in iron, but I think it's 520, 540. But we got somebody done at 540 had put 25% down. So you have the FHA rules, and then most lenders, they have what they call overlays. Like, hey, FHA requires A, B, C, D, but also if we're going to do that loan, we require A, B, C, D because that's FHA minimum requirements, and then we have E and F. And the E and F could be we're not going to take anything lower than 580. So I'm not condoning irresponsible credit scores or irresponsible borrowing, but I know we have a little bit less overlays. They had to put a higher percentage down payment on the FHA to get it to qualify.
Got it.
It offset some of the risk, and that borrower had, retirement funds. So they had some other stuff to fall back on. So I'm not saying that we could take any 540, but they had what we call compensating factors, like other things that make us feel good, like, hey, we can see why they had this run of bad luck and they fell behind on the credit, but that situation resolved themselves. Look at the time on the job. Look at the money they have in the retirement that they could fall back on in case of an emergency. They can withdraw to avoid foreclosure, and so they had compensating factors. But you're right that 580, most lenders will say, hey, that's a hard point for getting a mortgage. But a client working with you to get credit repair, there's so many benefits to it. What, on average, not just looking at a mortgage, what is the score, the median score that you're trying to get people to where they're going to be able to get credit cards, they're going to be able to buy a car, maybe buy a house? Because I feel like buying a house is kind of more forgiving than some credit cards and so forth.
Yeah, bankers are ruthless. These big banks, they're ruthless.
No, but I mean, sometimes somebody could not get approved for a credit card, but they can get approved to buy a house.
And that's sort of something that it came to mind while you were telling me all these little, areas. Like, the common knowledge, I guess, for what I've seen from most of the clients that I've worked with, and I told you I've worked with hundreds, if not thousands of people at this point, they don't know. The only thing that they think about is like, oh, I have to give somewhat of a down payment, whether it is 10%, 5, 8, if I'm getting some people don't even know actually that for a home, the down payment you have to pay is completely different from a condo, for example, but that's kind of like the average knowledge, but people know. They don't know that they have so many programs, so many packages that you can actually mix and match to be able to get a home. I think it's really easier. You hit it. Like, it's easier to get a home than get into an American Express Platinum right now, for example.
Yeah. And that's what we would call a premium credit card.
Exactly.
And I find all that fascinating. So when you take a client in to Score Pro Financial, do you ask them what score that they're trying to achieve?
It depends.
What their target score is?
Yeah,
How does that work?
It's a personal relationship, right? So like, hey, what's your goal? Why are you here? How come you reached out to us, right? Because we don't do ads. We don't do anything like that. Everything is either word of mouth, or somebody knows somebody, or clients refer themselves, or they just find us somewhere. They heard about something. I'm big in social media, so maybe that's another way that people could reach out to us. But what do you want to do, right? Like, if you're trying to fix your credit, it's because you want something, right? As bad as that sounds, what do you want? It's like, hey, do you want a home? Okay, so the average lender with us is asking for at least a 650. That usually gets them into like more options than just FHA, right? So usually that's our target goal. At least if the customer is in 400s or 500s, how do we get them to a 650 so they can already feel, okay, I have something. Even if it's the worst interest rate, even if I have to put a little bit extra, I can get a home.
Right. Yeah.
So at least we're trying to get them at least to a 650. But if they're already like early 600s and they can already qualify for a home, but now they're focusing on interest rates, for example, then that's when we talk directly with the lender sometimes. I have a lot of partnerships, just how you mentioned. For example, I would just give you a call. Hey, Marcel, what's the minimum requirement that we need as far as scoring for us to be able to get them the lowest interest rate possible, right?
Sure.
5, 6. I don't know if you guys are still doing 5s at this point, but 6, 7 instead of the 10, 11 or 12 that person was getting at a early 600 or a 580. Right. And then you will tell me, hey, the most I could do within the lines or that gray area will be a 700. Then we will create a full plan for us to get them to a 700 so they're able to take the most benefit out of it.
So would you say 700 is the most obviously you can go to like 800s. People hear about that. Very few people are in the 800s.
Yeah.
But would you say is a good overall score for a consumer to, hey, you're probably going to get approved for credit cards, you're going to get car loans?
It was 720.
720
it was 720. Yeah, okay. It was 720. That should be the goal. I think recently, because of what happened in the year and this past couple of years, it went up to like a 750, 760.
Okay.
But usually that's what we call tier 1 credit, right? Once you hit that 720, 740 range, nothing changes after that. From 740 to 850.
Yeah, that's what 740 is like, yeah.
That's it. You got over that hump, you get all the benefits that you can get.
Yeah, you're not going to get extra cherries on top. You're not going to get
any better.
Yeah.
That's it. So like, that's why people with I need to get to 800, I need to get to 850. It's like, those extra 100 points do not make any difference. You already made it. Right. So, and honestly, to get to an 800 and 850, at that point, you just need time. Again, we're going back to that formula, right? Time. Right. How long have you been dealing with all of these accounts that you've been having? Have you been defaulted on any payments? And that's how you honestly get to an 850.
Gotcha.
Yeah, now, 720, 740.
Are we talking, we've been throwing around all these points. Are we talking FICO?
Yes, we're talking FICO.
All right.
We're talking FICO because there are multiple scoring models,
methods,
right?
But FICO is generally what most banks, mortgages, credit cards, they're gonna look at a different FICO score.
Correct. There are multiple formulas of FICO score, different formulas of versions of FICO as a whole. Most lenders right now should be at least at FICO 8. At least. I still every now and then get surprised with a FICO 7, a FICO 6. That still happens. The mortgage industry, it's so big that it takes them a while to update all of those systems. And we're up to FICO 10T.
You know, I see a lot of clients that come to me and they'll tell me their score, and I'll say, well, where are you checking the score at? Because I want to know how reliable it is.
Yep.
And so a lot of people, they use Credit Karma because it's free. And first of all, I congratulate them because everybody should monitor their credit through some system. So whether you're using Credit Karma because it's free or you're paying a subscription somewhere else, I'll tip my hat to you, say, hey, you've done the first step. You're monitoring it, you're measuring it. And so whether you're using Credit Karma, which uses Vantage, correct? They give a Vantage score.
Correct.
And what I found in the mortgage industry is generally that Credit Karma score will be about 30 points higher than the FICO score. So the client will come to me and they'll say, hey, Marcel, I'm at a 650. And then they got that information from Credit Karma. And then I run the credit and it's 620. And they're like, no, you're wrong. And I'm like, I'll show you the report. I want you to have as high a score as possible because it makes it easier for me to get your loan done. I can give you the best terms, and I'm going to have less rules that I have to things that I have to prove if you've got a better credit score. It makes my job easier. But Credit Karma uses the Vantage
3.0.
So I want to try this analogy out on you and have you critique me. So the way I try to explain it to my clients who don't deal with credit is like you and I do, is I say, look, number one, congratulations, you're monitoring credit. That's the first step to getting good credit is knowing where it's at. Yeah. So good job. I want you to understand that the Vantage score through Credit Karma is going to be about 30 points higher than FICO. Everybody uses FICO. As far as banking. There could be an exception to that, but I don't know. I've never ran into anybody, and I know a lot of people.
It doesn't happen. It doesn't happen that often.
So they're like, well, why is that? And I'm like, well, they measure with the Vantage system. It's a different system of measurement. And I said, here's the analogy I like to use. So let's say the late, great Kobe Bryant. We wanted to mention, like, if we could have him back and measure how high this guy's going to jump. And we're in Canada. And so Kobe Bryant jumps, and I measure it using the standard American system, and I say, oh, he jumped 36 inches. And then Canada measures it with their metric system, and they say, what would that be? Oh, that 36 inches would be what? I don't know. Is it higher or lower? 44 centimeters, they're going to say. We're both right. They measured 46, but it was centimeters. I measured 36, but it was inches. We're both accurate, but we're using a different method of measurement. That's the difference between Vantage scoring, Credit Karma, and the FICO, and that's why you get a different score. So the good thing about that, what I like to tell the clients is that, hey, if your Credit Karma is going up or going down, so is your FICO.
Correct.
The score might not be the same.
Directly proportional.
But you're at least getting a measurement of whether your score is going up or down. And generally, do you think it's about 30 points is the difference?
20 to 30, yeah, depending on the FICO model.
Okay.
Because Vantage 3.0 to like FICO 9, FICO 10, it's fairly similar. I've seen recently, what was it? Maybe like a week or two ago, I started pulling out, because whenever I pull out credit reports, I give free credit reports to the customers whenever they join the program. I do pull it out on Vantage 3.0. I do get that rebuttal a lot. I say, hey, but it should be FICO. It's like, honestly, I really don't care which model I'm using, because at the end of the day, I need the most information so I can remove all those negative items. And if your Vantage went up 50 points, your FICO went up 50 points. They're directly proportional. So like, I really don't care where I get the score from as long as it's going up.
Okay.
Yeah.
Okay. Great. So you like the analogy?
Yeah. No, that was great.
Okay. Super. I had to get your expert opinion to see if there's anything I needed to dress up. I mean, I know that the point is right, but you're the expert in that. One thing I want to cover while we're here is people are terrified about getting the credit pulled, like their score is just going to drop. So we offer soft pulls. We'll do a soft pull, and a soft pull you won't lose any points on that. But can you talk about a soft pull and a hard pull and your thoughts about pulling credit?
Yeah, I mean, honestly, at this point, if somebody's doing a hard pull on you,
Old fashioned?
Yeah, something is not going right. Because I think every single person has the ability to do a soft pull now, right? If you're a banker, if you're a lender, if you do not have, please go ahead and spend the extra, I don't know, $10, $20 to do soft pulls, because one, it gives you a much trustworthy version of stuff. It's like, hey, I can pull this out and it's not going to affect you in any way.
Right. You're not going to lose a point.
Everybody's so scared of it. And believe it or not, it is part of your formula. New credit inquiries is part of the credit formula for them to be able to calculate your credit score. 10% of your entire score comes from inquiries, right? So, yeah, it does drop your scores.
And they allow you to have some pulls. They just don't want you to see that you're applying everywhere.
Something that I learned that my old mentor used to say, it's like, look at it as symptoms to a disease, right? So if you go to the doctor and then you say, hey, my eyes hurt, and then my ear is hurting, and then my throat is itchy, and then I'm getting headaches, and I'm also getting a fever, he's probably going to say, hey, I think you got a cold. You might get a flu. Is your stomach okay? Like, what's going on?
Sure.
Those are symptoms, right? Same principle applies if you're a banker, you're a lender, and you pull out credit reports, and you see that, oh man, Kobe Bryant has 30 inquiries since he came back. What's going on?
Yeah, something's going
like
on here.
all of this happened within the last 2 months. Oh man.
But a soft pull doesn't show up in the inquiries.
Correct.
Not only do you not lose points, it doesn't show up in the
It
inquiries.
doesn't show up in the inquiries.
So, yeah, we're using the soft pulls for qualification purposes. If we get to the point where we're going to do the mortgage or buying a house or you're doing a refinance, there will need to be
That's awesome.
hard pull. But if you've got a good credit history, you're not going to lose that many points of it. You read these things online on these online forums, and they say, I did a credit pull and I lost 30 points or 40 points. There's no way that should be happening. The only way that I would think that you would lose 20 or 30 points is you don't have a long history. Let's say you're 18 years old, and then you go to, say, for example, a big box store to buy a TV, and they're like, hey, I'll give you 10% off if you sign up for a credit card today.
You'd be surprised the number of cards. I'll tell you. Sorry to cut you. Best Buy happens all the time. The Home Depot happens all the time. Victoria's Secret happens all the time. And
these
then
smaller lines of credit.
If you're down here, Macy's definitely gets a lot of people.
So you're 18 years old. You go to, let's say, Home Depot, and they say, hey, I'm going to give you 10% off of this $2,000 TV if you sign up for a Best Buy credit card. So you don't have a lot of history to offset that credit pull. They give you a line of credit exactly for the amount of the TV. So now that's a maxed out new line of credit.
Yep.
And then you don't have any history paying it. And that's not just because you had a credit pull. It's because you've got a maxed out credit line. You don't You don't have a long history, and you don't have any history of paying that debt. That's why it's a combination of things. But if you're 30 years old and you're applying for a mortgage and you have credit history, and it gets to the point where first we're going to make sure you get qualified with the soft pull, but later on, if we have to pull your credit because we are going to do a mortgage, you are buying that home, you might only lose 5 or 6 points. And it's a range of 350 to about 850, right?
Yes.
Generally?
Yes.
So 6 points on a 500 up or down scale is nothing.
Yeah.
But you don't want to let everybody pull your credit all the time.
You don't want anybody to pull your credit all the time. Something that I do get a lot is like, oh man, I went to the car dealership and they ran it 50 times for every single lender that they have to be able to do that. It does bring your score down, but all of those inquiries count as one for the first 30 days. So
even on a car?
Yes.
I didn't know that.
Even on a car,
Good advice.
Yeah, so like all of those, they just count as one. They all got pulled out from the same principle, and their formula itself just takes it as one. So for the next 30 days, honestly, that's usually, hopefully you get a car inside of those 30 days, because if you go, let's say to Nissan.
They call it the shopping period.
Yeah,
I know that with the mortgages,
exactly.
It's the same thing.
So you go here, they pull out yours to see if you can get with Nissan, then you go to Toyota, and then they pull out again to see how many you can get, and then you go back to Lexus because you apparently you found out that they're Toyotas as well, but they're prettier, so you go, and they put all of those inside of that 30-day window will count as one inquiry.
But that shopping window, because we have the same thing in mortgages, only for car loans. So that 30-day window doesn't count if you go to Best Buy.
Correct. And trying to get that TV all over again.
Yeah, different credit cards. That's outside of that shopping window for a car.
Correct.
We have the same thing with the house.
Oh, I didn't know.
Yeah. It's like 45 days.
Oh, nice.
So that.
I wanted to talk about a HELOC.
Okay. Well, HELOC. It stands for Home Equity Line of Credit. So the nice thing about a HELOC is that it's an open line of credit. So let's say you get approved, you have a mortgage, a first mortgage, and let's say you owe $300,000 on this house, it's worth $600,000. The HELOC is a secondary loan, and let's say you get approved for $150,000. So now you have $300,000 plus another $150,000 HELOC. So you only owe $450,000 total of a $600,000 house. So that's the example we'll go with. HELOC is, okay, hey, Danny, we're going to approve you for $150,000. And it's kind of like it's a line of credit where you don't
So
have
it's a completely different one, right? So you have the mortgage and then you're getting an extra loan on top of it.
Right. And so you don't have to take out at the closing of that loan when you sign the paperwork, you don't have to take out the full $150,000. You have a $150,000 credit line. So your payment can go up or down based upon how much of that money you withdraw. And as you pay it down, you can, let's say you take out $100,000 to begin with of the $150,000. You pay it down to $70,000. Well, then you opened up that $30,000 extra. Like, hey, I still owe $70,000. It's $150,000, so I can borrow theoretically roughly $80,000 more.
Do people usually take the whole amount?
On a home equity line of credit, no. But that's how it differs from a closed-end second or a closed-end second. Whereas if that $150,000, when it's closed in, it's not a home equity line of credit. You take the whole money out at the closing, and then it's a set payment based upon the interest rate over a certain amount of time that you have to repay that loan. So, but a home equity line of credit could be a good tool if you have high interest rate credit that you just can't pay down, maybe because of inflation, credit cards got out of control.
Right now, we were talking about it before we got into it. We started recording that, like, it's all-time high for credit card debt. I think it's like we're at the trillions.
Ideally, you want to pay your debts down and not be in a high, what we call high leverage situation. But if you've got a credit card charging you 15 to 20, 23%, and you can get a home equity line of credit that's at 8 or 9%, for example, then it's going to save you money. Plus, you can pay off that credit card and not have. And a lot of times, what it'll do is the home equity line of credit, because it's based upon a 20 or 30 year period, might only be a $200 a month payment, where the minimum payment on that credit card might be $400 or $500, depending on how high your balance is. So it can be stress relieving as well. But it'll save you. It's a smart tool if you get in that situation to lower the interest rate you're paying on your debt. So
that's awesome. That's a great option.
Yeah.
I don't think you can do that in third world countries like South America style. I don't remember people like, well, I never bought a home in South America. Do you have you bought property in South America yet?
I'm working on it. Yeah.
Nice.
I'll tell you about it when it gets closed.
So Medellin.
Yeah. We won't go into too many more details besides that. So,
oh man, this is awesome.
Yeah, but it's investment property. I like the cabanas and stuff like that. There in the mountains is what I'm working on for investment property, kind of like an Airbnb
style.
With the what I'm saying?
Like Guatapé, like by all that.
Yes, Guatapé. Nice. There's a lot of money to be made, and the upkeep because the labor is cheaper is
of course
very very manageable. It's good for.
There's a lot of things happening in DR as well.
Yeah.
A lot of land being sold in DR.
Yeah, great opportunities. Yeah, if you can invest in property and it's secure, like it is here in the U.S., highly recommend it.
Awesome.
All right, well, let's wrap it up here.